Get YouTube to pick it up here.
Yep. All right, that's your main camera.
Okay, let's see.
Okay.
Here. Commercial financing, is that what we're talking about?
We're talking about owner financing
Owner financing.
on commercial real estate. Yep, owner financing on commercial real estate. Ooh, I got a date with this mic. Right up close and personal.
Okay, so let's see. Okay,
We live?
I think we're live.
All right. It's Real Talk on Real Estate Friday morning. Jerome Maldonado here. Welcome everybody to Real Talk on Real Estate. I'm excited today, like I am every day when I wake up. But today we're talking about owner financing on commercial real estate. Now look, one of the big topics that everybody wants to know about is how to finance any type of real estate, commercial real estate, residential real estate. It doesn't matter. They just want to be able to get in and purchase. And I don't blame them. Right now, with everything that's happening with the coronavirus, there's opportunity out there. And I've been talking about this for the last 2 years, that I knew something was coming. We had been in a stimulated market, and now it was just the pandemic that stimulated this stuff. Well, look, we did an awesome talk last night on Clubhouse. We spent about 2 hours with people interested in investing in commercial real estate. And I'll tell you that the receptiveness to people wanting to get into commercial real estate investing is just priceless. One of the big things is, it's so profitable. And with all the opportunity that's unfolding right now, I know that a lot of people are sitting back going, okay, what do I do? Where do I invest? And what do I invest in? And so I want to talk to you guys a little bit about that. We've been doing a lot of these live shows on Wednesday nights, Friday nights, Clubhouse, and we're bringing you up close and personal to a lot of the back office secrets that we do each and every day. Why are we doing this? Because we need you guys to make some money. And one of the big things is getting you guys to get in and make some capital that you guys can invest in some of these larger deals. Right now, there's opportunity out there in the residential market, but more so in the commercial sector, and it's unfolding. As we get to the end of 2021, we're going to start seeing market sectors in the residential and commercial sector unfold. Foreclosures and short sales that we haven't seen in almost a decade now. It's been, 2008. You think about 2008, took about 2 years for the world to succumb to all of the craziness from the financial crisis of 2008. Here we sit well over a decade later, and the market hasn't dipped at all until Corona came. And so I want to talk to you guys today about how to purchase these deals. We had a huge outreach. Last week I talked about different finance options. And being that obtaining finances is one of the most sought after areas of interest for people investing in any type of real estate, I wanted to talk about owner financing because that's where most people question is. They say, okay, where can I get involved with real estate with either minimal amounts of money down, no money down, or how do I utilize other people's money? And so owner financing was a great way, is a great way, not was a great way, it is a great way to get involved in real estate. And so I want to go over the ins and outs of that and talk to you guys a little bit about how you guys can put to work other people's assets and the other people's money to obtain real estate in assets for you, which is incredible. Now, look, if you like this content, you want to continue hearing more, give us a big fat thumbs up on YouTube, pound that subscribe button, and join us for more content just like this each and every week on YouTube. So, Real Talk on Real Estate, owner financing. Look, when I first got started in real estate, I didn't have a ton of money. I had just finished going under on one of my businesses, and it took me about a year to figure things out. We were trying little petty businesses that were generating $4,000, $5,000 a month. This is back in the 90s, mid 90s and late 90s. And then about a year later, I accidentally landed up in construction. When I say accidentally, it's because I never thought I was going to land up in construction. My mom and dad used to tell me, hey, look, go to school, get a good education, because if you don't, Jerome, what's going to happen is you're going to land up working in construction. Lo and behold, I didn't realize there was millions and millions upon millions of dollars out there for people to make in the construction trade. And so I had a philosophy. What if I ran a blue-collar business, but instead of running it like a blue-collar business, I was in pharmacy school at the time, and I said, hey, why don't I run a blue collar business like a white collar professional? Because I was proud of my degree and I was proud of everything I'd done. I said, why don't I run this business like a white collar professional, and let's go after this. And I did, and that was my whole philosophy. It's still my philosophy today. So I deal with white collar professionals, take white collar professionals' money in exchange for a service that they can't get anywhere else with more professionalism and a better quality product than they can get anyplace else. And that's what we've stood behind for years and years and years. So I was able to generate a little bit of capital my first year in business, and I had a few $1,000s to invest. But I still didn't have credit because I'd ruined my credit going after the big dream of entrepreneurship, business. And in the interim time, I had to figure out a way to get started and continue moving forward. And so owner financing was a very attractive option for me. Now, in those days, I didn't know anything about owner financing, didn't know how to leverage it, didn't know what it was, but I had a really cool real estate broker at that time, and she was the one that introduced the option for owner financing. Now, my first property that I ever bought utilizing owner financing was a commercial strip mall. It was a retail center, about 8,500 square feet. And one of the things was it was an asset that was inherited through trust and through an estate. And so the kids received the asset. The dad was the entrepreneur who had businesses, real estate. And the reason I'm telling you this is because right now with the pandemic, there is an age class, a lot of baby boomers that are sitting at an age class where they want to retire. They don't want to deal with the headaches of business anymore. And they're asset rich. They just don't want the headaches. They don't want to be running leases, and they don't want to be doing things like this. And so it's a great opportunity for them to throw in the towel, retire, and not only throw in the towel and retire, but give opportunities to people just like you and just like myself. But not only that, there's an educational process as a professional that you'll want to give to sellers because there's tax benefits for them to do owner finance deals. Not only is there tax benefits, but it's also lucrative for them because they can end up generating more capital on their asset, more so than what they were going to sell it for. So they can go in, you can negotiate a sales price with the advantageous fact that you can sit back and say, look, not only do you get the sales price, but if you owner finance it for me, you're going to be generating interest payments from me for the next 2 years, 3 years, whatever the terms are that you negotiate, which we're going to go into today. Well, anyhow, as we unfold this, I'm going to kind of share how I utilize my story and what we've done to set up a structure for you guys that we've been utilizing for over 20 years on owner finance deals. And so some of you guys are sitting back saying, okay, what is owner financing and what does that mean for me? Well, what owner financing is when an owner has a property, has interest in that property, and also has they're asset rich in that property, and they want to be able to take their equity, give that equity that they have to you in mortgage payments. The owner becomes the bank. They finance it for you. Okay. Now, the benefits of owner financing are, one, you don't need a lot of credit. So if you have bad credit and you've over leveraged yourself, and let's say your debt to income ratio is bad, you can still get into real estate because typically they don't leverage your credit to approve an owner finance deal. So you can have little or no credit. Another thing is banks. If you're doing traditional lending, SBA lending, a lot of times it requires X amount down payment, which is usually between 20% and 30% down payment, sometimes even as much as 35% on a down payment, loan to value ratio based on the value of that property, right? So if you come in, you get an appraised value on like a $1 million building, you need to be able to come up with $300,000 essentially as a down payment to purchase that through traditional financing. But the same $1 million building, their owner financing, depending on negotiations, you can realistically go in and put $100,000 down, and sometimes even less depending on the circumstances and the actual purchase. And so it allows you to keep more money in your pockets right from the very beginning. And it allows you to be able to acquire real estate for a lower acquisition price. Now, I always caution people because one of the big things with putting a low down payment in is you don't have a lot of equity in that property. And so when there's times of financial distress, you want to make sure that the income potential of that property exceeds the liability amount. And what I mean by that is if your payment on $1 million building is going to be someplace in the neighborhood of about $6,000 a month, you want to make sure that that has an income potential of maybe $9,000 a month. And so this way you have a buffer in there. That way if something goes slightly dry on you, you could still service the debt to that property and be able to keep that property affluent. Now, with that being said, when you're negotiating the terms, you do the same type of term negotiations that you would typically do with a traditional lending institution. The difference is this. With lending institutions, they usually call the shots. They usually have parameters. You can ask and negotiate slightly, but they still have to fall within their banking requirements to lend you money. With an owner finance deal, you can negotiate the terms in almost every sector. So what I always tell people is always put in a 90-day default clause in a real estate contract. Minimum of 60-day default clause, but try to get a 90-day default clause. So what that means is that there's not a take back, a repossession, a take back on that property for a minimum of 90 days. So if you're structuring this deal and you're negotiating it, say, okay, I have a 90-day default clause. If I don't pay for 90 days, then you can come in and take back the asset from me. You can foreclose on it, take it back. They don't have to give you back your down payment money because you're in default. Okay? Now, I've been negotiating a deal down in Chicago, and what worked in our benefit with this project was exactly that. This gentleman had a hard money lender. In 2008, he went in, he had traditional financing. He didn't have the property leased, and the banks were hot on every investor's back in 2008 and 9 because of everything that was happening with the financial crisis. They were trying to balloon his payment because the building was not appraising for the value it was prior based on the tenancy that he had. Because on a commercial real estate, they value the real estate based on its income potential and what it's generating as far as cash flow. So if it's not generating the cash flow, the asset is not worth anything to the financial institution because it's not an asset, it's a liability, and the banks don't want liabilities. So in 2008, when the financial crisis hit, they were going back after people that didn't have the proper loan-to-value ratio, and if those assets had depreciated based on lost leases, what happened is they started foreclosing. This is going to happen based on the forbearances and all the financial moratoriums that are set in place. And as these expire, the exact same thing is going to happen because we're going to have all these assets, a bunch of tenants that are forced out. There's going to be a ton of evictions. There's going to be people that have been saved by these moratoriums. But when they expire and these tenants are pushed out, the income potential is no longer there. The financial institutions are going to start to push on these people. Well, this individual out in Chicago, what ended up happening is he was forced to go get another loan, sell the property, or he was going to lose it back to the bank. And so what he did is he went and got a ridiculous loan from a hard money lender, and which is great. It would have been a great move in the interim time until he could obtain long-term financing again through another financial institution, one thing smoothed over. So see, this was 2008, maybe pushed out to 2010. He should have refinanced the property back in like 2016 and got traditional financing again, but he got comfortable. And so a lot of times what happens with investors is they get too comfortable in a deal and they land up just sitting there servicing the debt. And so he started servicing the debt in this hard money lender. Well, guess what happened in 2019, moving into 2020? The hard money lender passed away. All of his notes went over to his estate, and so there was a 30-day default clause in there. So they allowed him to continue doing business as he did business. He went on vacation, forgot to make one payment, 30 days. He was over 30 days late. The estate exercised the terms of that owner financed, not the owner finance deal, they exercised the terms in that hard money contract that he had obtained. And so what ended up happening is they're doing a forced sale on him right now. They want their $2.1 million. Well, the building's worth over $3 million. The appraised value is between 3.4 and 3.8. The only problem is people are tight on their money because of everything that's happened in the pandemic. So we don't want to pay retail price for a building. So we've been negotiating back down to $3 million so that we can acquire the asset at the right price at the right time. And because he's forced and leveraged to be able to go in there and sell based on his hard money lender's requirements of ballooning that payment, he has to get out of it. So what I'm urging you guys to do when you guys are doing owner finance deal, hard money lending, any of them, is always exercise a minimum of 90-day a 90-day give back time, a 90-day default time on your loans. Minimum of 60 days, but try to get 90 days on the default period. Okay? Now, go back. There's a ton of benefits to owner financing. So low cash down payment, owner financing. You know, a lot of retail. One of the things when I first bought my first building, and one of the things that worked out well because of owner financing, you guys are going to find distressed assets. And there's two different types of distressed assets, right? There's physically distressed assets, things that have been weathered over the course of time. They haven't been renovated. They need a little bit of a TLC to be able to obtain better tenants and to be able to lease the property for its true value. And then there's financially distressed assets. We're going to see both of them right now coming out of this pandemic. We're going to see more so financially distressed assets. And so one of the things that normal traditional financial institutions want to see is they want to see stabilized income. And so what owner financing allows you to do is it allows you time to be able to stabilize your asset. So where traditional lenders would not typically lend on an empty piece of real estate, a warehouse building, a small retail center, office is going to come back, ladies and gentlemen. I'm telling you guys that my projections for office is that it will be back. People won't stay working at home. They like the commodity of working with others. They like that in-office commodity, the energy of getting up every day, going in, being able to socialize with people, having that cup of coffee, and being able to have that office setting. Those boardroom table meetings instead of Zoom, that stuff will come back. This distant office work, it's great in the interim time. It's working, but it's not going to survive. So small office is going to be, there's going to be a need for it in the future. It's a great ways to take advantage of real estate contracts on distressed assets that are empty right now. Businesses that put their employees back at home, these places went dry. They did it to save money on their monthly payments and their overhead. And now their employees are going to land up coming back to the office. E-commerce is going to continue growing. Social media marketing companies, there's going to be a huge need for people to come in and do business in office. And so industrial warehouse space, hotels, motels, hospitality brands, distressed retail, office, there's opportunities in all these sectors. Problem is that traditionally, when these things get financially distressed, that means they're empty or have very low tenancy, which means high in vacancies. And so the banks don't like those. They're not attractive to them. But through owner financing, you can obtain these assets, take ownership of them, go in, do what you need to do to renovate, add value, stabilize income, go in with the right sales price, the right negotiations, and then stabilize that asset. So brings me to another negotiating term. You want to make sure that when you're doing real estate contracts that you never negotiate in a balloon payment or a call date. Now, a lot of times you do want it, they'll require a call date, but if you can exercise one and negotiate no call date, the call date is the date that the term of that note expires, and then the payment balloons, which means you have to pay whatever's left on that payment, you pay all at one time. And so with owner financing, I always tell people, negotiate a minimum of 3 years. That gives you 3 years to renovate, stabilize the income, and then you can refinance it within a 3-year period and go to traditional lending. Now, if you stabilize that asset sooner and you want a better interest rate, you can go in and obtain traditional financing quicker, so that way you brings your interest rate down. Because typically with owner finance deals, you want to negotiate someplace between 6% and 8% annual percentage rate. And so this way you're not going after like a hard money lender where you're leveraging 10%, 12%, 15% on your payment. You can go in and negotiate real similar terms to what you're getting from banks. Now, banks right now, because money's cheap, are financing commercial deals if you have good credit and it's a great asset for between 3 and 5%, depending on where that asset sits and what type of asset class it's in. So after a 3-year call on that owner finance deal, what you can do is come back in to the banks, renegotiate, and say, hey, I want I want to come in and get a loan on this asset. Now, maybe you paid $500,000 on that asset. And that was the price that you negotiated because it was financially distressed. But let's say, for sake of example, that same asset now is producing $150,000 to $200,000 a month in rental income. And so what ends up happening is the value of that asset appreciates. And so now that same $500,000 price that you paid in financial distress for this real estate is now worth $800,000, $850,000. And so you go back to the bank, they do an appraisal on the property. You have the thing 85, 90% fully leased. And so they come back and say, okay, there's an appraised value of $810,000 on this asset. And so because the bank wants 70% loan to value, your 30% that was required as a down payment is now absorbed because the asset is worth more money. So when you go back in to renegotiate the terms of your long-term financing, you don't have to go back in and put 30% down in 3 years from now. And that's a big misconception for people, because sometimes people sit back and say, oh my God, I have to come up with another $150,000 to refinance this. And you don't, because what happens is you appreciate the value of that property based on the income model of appraisals on commercial real estate, because you've stabilized it. Now you have tenants. It's producing cash. It's no longer a liability to the bank. It's an asset to the bank. They want that in their portfolio. So now you go back to the bank, they underwrite it, and they say, yeah, you got plenty of equity in this property. Let's do $500,000 loan. You just go in, you pay off the owner finance deal a few years later, and then you walk into traditional financing, and now you're saving either more money a month or you're putting more towards principal. What I've done in the past, I usually put more towards principal to allow myself the ability to pay off that asset quicker, so that way either I can leverage it, go buy another asset, or just pay it down and utilize it with cash flow for the rest of my life and just keep and hold that asset. So I have a real hard time selling assets that are cash producing. We have some properties that I bought that were supposed to be interim properties that we were going to flip in the winter as projects. And then I landed up stabilizing the income, renovating them. And after I renovated, I look around and say, holy shit, this thing is beautiful. Not only is it beautiful, people love it. Why? Because there's typically garbage around not garbage, but a lot of real estate, even in premier areas, it gets physically distressed through use, but people and owners don't land up going back in and putting the money into to those assets to be able to renovate them. And so you sit back, one of the nicest properties in the area, and people become very attracted, and you just lease it for the current market value, so people get more for their money. You land up creating cash flow. Why would you sell the asset? You don't even have to sell it. You can just refinance it on better terms. Even if you pull out a little bit of equity, you pull out that equity tax-free. Tax-free. So if you sell the asset and you sell it for a profit, you end up having to pay capital gains tax or ordinary income taxes, depending on how your business structure is set up in real estate. Why would you assume the tax liability when you can just have that thing cash flow for you? You could pull a little bit of your equity out of your property, take that capital tax-free, invest it in something else, and just revolve that door and continue doing that over and over and over again to build your asset, to build your wealth, to get wealthy in real estate. This isn't real talk on real estate to go broke. This is real talk on real estate to get wealthy in real estate long term. Okay, now it's not an overnight deal. I'm not going to sit here and tell people, you know what, let's get rich quick. This is a get rich quick deal. Come on, come with me. Come with Jerome Maldonado. Let's get rich quick. This isn't a get rich quick deal. I've been doing this game for 20 years. Have we gotten wealthy through the means of real estate? You bet your ass that we have. And I'll tell you what, you can too. You just have to exercise some of these simple concepts that we're talking about to be able to leverage other people's money, other people's assets, so that you can go in and take advantage of the exact same opportunities that we have. And the time is right now, ladies and gentlemen. We're moving into a place with this pandemic that's going to open doors that you won't see again for another decade at least. And so, okay, what other good stuff do we have on owner financing that I'm missing, that I'm forgetting about, because there's so much. This stuff gets juicy, and so I take notes so that I can make sure I don't leave any of the juice out for you guys, and I give you guys each and every bit of what I do each and every day. Okay, so tax benefits. That's a huge one, guys. The tax benefits of owner financing is big, especially for the seller. And so if you guys even land up with a property and you guys do land up wanting to sell, but you guys don't need the capital out immediately and you just want the cash flow, this is great for people that are doing like single family homes, even though I advocate for commercial real estate because one, it's easier, less expenses, and two, it's more profitable. And so I just advocate for profitability because I want to make money. I didn't get in this game to go broke. I got in this game to get wealthy. And so biggest thing with assets is how much money can I make, how quick? And so I love commercial real estate for that purpose. But the tax benefits for the sellers are huge. So if you go in, you buy a $500,000 property from somebody, it offsets their long-term capital gains if they do an owner finance deal for you. You pay them the full $500,000 for that property, and that property's paid off. Now they're assuming, and let's say they've depreciated that property over the course of time. So on their books, they're only showing the value of that property for tax purposes is only worth $200,000. Well, now they just assumed a $300,000 liability on that $500,000 purchase that they're going to have to pay back 25 to 40% back to the big man, the IRS. And so if you want to keep that money away from the big man and you want to be able to keep that money in your pocket, owner financing is a great way for sellers to offset their long-term capital gains taxes. Because if you go in on that same $500,000 property and you just put 10% down, put $50,000 down on that property, they're only assuming the tax liability on $50,000. And so when you pay the property off, then they'll assume that liability 3 years, 4 years down the road, and they can start accounting for that early on to be able to save up the money for that tax liability. Not only that, they're able to generate revenue. And so they'll be taxed on the revenue that they're generating. But let's say your monthly payments on that property are $3,000 a month. You paying them $3,000 a month, they're only paying the taxes on the $3,000. But here's the difference. Now that building that they did an owner finance deal on became a business. So every time they drive down to check on your property to make sure that you're keeping it up to speed, it's a tax write-off. If they go in and have lunch with you, buy you coffee, anything they stick in the mail to you, all of that stuff are tax write-offs. And so they can spend and have expenses on that property still, even though you own it, you still get the same tax write-offs and tax benefits that they do on that same property. But because they're owner financing it to you and they're the bank, they can also expense all of their expenses surrounded around them dealing with that owner finance deal that they did for you, which is awesome. And so most sellers don't realize this. So your job is to be an educator. It's to teach them this stuff. It's to be able to get good enough underwriting deals and looking at all these options. And that's why I go over it with you guys. I say, look, you can become educated in this, understand these tax benefits for them. And if you educate a lot of sellers, they don't even realize this because people aren't accountants. I'm not an accountant. I'm not a CPA, and I don't claim to be one. I've just learned from very good accountants and CPAs, and they've said, hey, look, if they sell this under an owner finance deal, we can offset these long-term capital gains taxes. And not only can we offset these long-term capital gains taxes, it's a benefit to the seller. Let's educate them, let them know, because otherwise they're going to sell this $500,000 asset and they're going to pay $150 back to the big man, to the IRS. Now, you take a $500,000 sale and you land up with $350,000. That's not a good day. That's painful. And so instead of feeling that pain, why not offset those capital gains taxes and just take smaller proceeds over the course of time, plus generate capital on it? So the tax benefits are huge. If you're selling a deal like that, same thing goes for you. Why not offset those long-term capital gains taxes? Wait till you have a bad year and you don't have as much tax liability, because there's going to be fluctuation in the market. You're going to have extremely good years where you've made a ton of money and your tax liability is way high. And then you're going to have other years where you're in the middle of projects and you didn't have as much capital. That might be a good year to sell that off and assume that tax liability, since you have a small tax liability that year, and then you can offset it into that year. So you can negotiate that. Now, one thing that I'll do, and I like doing with owners, and I'll tell you guys, depending on what the market does, and this is what I like about times like today, is that I look at the trends of the market, and I say, okay, I have a 3-year deal on this owner finance contract. In 3 years from now, this thing balloons on me, and this guy's going to want 100% of his money. But what if I could stabilize this asset in a year from now? I can come in and renovate in 6 to 9 months. And then I can get this thing leased in another 3 to 6 months. I stabilize that asset. It's financially rich. And so let's say that maybe 14, 16 months after you purchase this property, you go back to the owner, because money burns a hole in people's pocket. They always want that cash. Some people might say, nah, I don't need the cash right now. I'm in a good place. I got my fixed income. I got my Timex and my monthly check coming in from my pension, and I got Social Security paying me, and I don't need the money right now. But for the majority of people, that money burns a hole in their pocket. They sit back and go, okay, yeah, I'd love to get my money out. And so knowing this, that money burns a hole in Americans' back pockets, and they want that capital in spite of tax liability, a year and a half into the real estate contract, there's still a year and a half left. You go back up to the owner and say, hey, I know I still owe you $450,000 on this $500,000 building. But I'll tell you what, if I just paid you all of it up front, would you take a $50,000 discount off the asset? And they might not, but they might take a $30,000 discount on it. And so how many of you guys would turn down $30,000 in your bank account right now? Hell no. I'll take that $30,000 discount. And I can't tell you how many times I've done this. I've went back to sellers a year and a half later after I stabilize the asset. I go and obtain traditional financing, and I'll already have my note set in place. So regardless whether they discount it or not, you've already negotiated a great term prior. So even if they say no, you still refinance, and it's advantageous for you to do this, put it into a long-term note. But here's the kicker. What if you can get a discount on that property? And I'll tell you, I'd say that probably about 70% of the time, I'm successful getting some type of discount for paying that owner finance deal off early. You sit back and go, oh, because of the market, because of the X, Y, and Z, because President Trump ruined the world, and because Biden's the god of the world, whatever it is in your book, you can go in and say, hey, there's craziness happening right now, and because of that, I know financing is going to be hard to get, but I got capital in my bank account, and I'd love to give it to you. And in negotiation with you, why don't you discount the property, and I'll just pay you off before the 3 years, and you can go off to Haiti and just go have a great vacation, and go off to the Bahama Islands and just enjoy yourself over at Atlantis with your wife and kids. And let's just dust off our hands and call this contract paid in full. And so a lot of times they'll sit back and they'll think about it and say, well, let me consider it for a little bit, and they'll come back and they'll negotiate out of it, and you may get a $20,000, $30,000, $50,000 discount for paying that asset off early. And then you go in and you put that down to your bottom line. And so all of this is just plucking away at your bottom line. That's what it is. I'm just looking for ways to get that asset stabilized for a better value and more cash flow, get that asset paid off so that thing cash flows for me forever. And so think about how long it takes you to generate $30,000 to $50,000 in income. Take that off of it. I don't care if you're making that in a month, a week, it's still cash in your back pocket. So negotiate it. So with that being said, you never want to negotiate an early payoff penalty in real estate contracts, which means institutional lending, a lot of times, they make their money over the course of time through interest. They don't want to go through all the underwriting, pay their staff, pay the commissions out for all of the loan fees to their brokers and all this stuff that acquired that loan for them. And then 6 months later, you sit back and say, adios, I'm out of here, amigo. I'm going down. I'm out of here. I'm going down. I got a better interest rate, a better loan, and you pay them off, and now the bank loses because they had more out in commissions to the broker that found that deal for them. They had expenses to the underwriter. That loan cost that bank money. So what they do is they do an early payoff penalty if you don't exercise maybe 3 years of that loan, because they calculate this math-wise. And just like everything's a business, real estate's a business, banking is a business. You go into a retail center, it's a business. So to a bank, it comes down to dollars and cents, just like any business. So they sit back, they get this note, and they sit back and figure out the math. And they say, okay, we need to have at least 3 years of interest on the terms of this note to make it worth our time financially. Otherwise, it's not worth it. Go to another bank. And so they'll put in a 3-year early payoff penalty. Especially in today's day and age where interest rates are really low, they'll put in an early payoff penalty of 10% of the entire note or a certain dollar amount. And sometimes they'll have it in brackets based on how long you kept that note. In real estate contracts, Never negotiate an early payoff penalty. In fact, negotiate out of an early payoff penalty so that what I'm talking about as far as the renegotiations of going in and selling and paying off that asset for a discounted price works in your favor. Now, it's not going to work all the time. I'm not going to sit here and tell you guys that every time you go in on a real estate contract and offer somebody an early payoff that they're going to come back and say, sure, I'll give you a discount, Jerome, on the asset, because just down the street from the building I'm sitting in now, I have another property, and I did that, and these guys, they didn't need the money. They were older, and I sat back. I tried it 3 different times with them, and I tried to call their bluff. I sat back and said, okay, look, if I still owed them like $300,000. I said, if I come in and pay you guys $270, $280, and I do it all at one time, will you guys consider it paid off? And I tried to negotiate with them. They said, look, Jerome, you beat us up on the purchase. We already discounted the price the day you bought it. Now you want another discount, and they just wouldn't do it. So I called their bluff the first time and said, okay, I ain't going to pay them off then. And I was stubborn with it, and I said, I'll just keep their finance deals set in place. And so I did. 6 months later, I called them up, tried doing it again. They told me the exact same thing. Finally, I was like, okay, I'm sick of the interest. Paid them off, paid off the asset, and we moved on. So not every time is that going to work, but I'll tell you that a large percentage of the time it does work, and you can discount them. So always keep that in mind. Okay, what kind of other juice tips? Alec, my good man, what's the time on that clock right now?
So we're at 9:40 right now.
9:40. Okay. So ladies and gentlemen, we still got some juice coming out of this Real Talk on Real Estate for Friday mornings, and I got some cool stuff I want to update you guys on as well. But let's go over some of the other stuff here that I'm missing that I haven't talked about. Obtain traditional financing, allows renovation time, leasing time. You know what's cool about owner financing is you can really get into a piece of real estate with no money down, especially if you have a little bit of credit. You know, you guys get some credit cards, you know, that have like $40,000, $50,000, $100,000 limits on them. And you guys just get a bunch of small cards when you guys are young, and you guys call and have them increase those limits over the course of time. And your credit gets better and better and better, and you have all these credit cards, right? There's credit cards now that have like 0% financing. You can change from one credit card to another credit card to another credit card, so you never even incur interest on these things for months on end. And you can come and get owner financing, go in and leverage the down payment off your own credit cards, and you have no money out of your own personal bank account. And now you can go in, stabilize an asset for nothing, for no money down at all. That's what no money down real estate is, ladies and gentlemen. There's no such thing as no money down real estate. It's just none of your money down. It's everybody else's money in the world. You find an asset, get owner financing, use a credit card to finance the down payment, and it's no money down out of your pocket. It's the money down out of other people's pockets. A little cool book that I read years and years and years ago, one of the first success books I ever read, Think and Grow Rich by Napoleon Hill. He was commissioned by Andrew Carnegie, first documented billionaire in the United States. Carnegie Steel, and up in Pennsylvania, all the old steel world. And I'll tell you that he couldn't understand an immigrant come to America, get wealthy in America, and as an immigrant with nothing, and the land of opportunity, where the streets are paved in gold, right? Everything was based on capitalism. The home of the free, land of the brave. You can go in. People that were born and raised here weren't taking advantage of what he as an immigrant came in and took advantage of to become a billionaire. And so he commissioned Napoleon Hill to go in and figure out what the difference was as far as the mindset between the ultra wealthy and average people. So he went in and interviewed people like J.D. Rockefeller, Andrew Carnegie, Henry Ford, all the world's greatest. And what he found after a 25-year study is that wealthy, successful people, they just had a different mindset. They just tweaked things a little bit. And so he talks about utilizing other people's efforts, employing the efforts of other people's ideas, the ideas that Jerome's giving you guys right now. You don't have to think about what's going on in the market. I go out there, I do all the research for you guys. I go out and do market tests, and I go out there and say, okay, is this going to work? Like what we're doing with the hotel conversions right now, I sit back and go, is this going to work? And so once I figure out it's going to work, I say, it works. We're making profitability, and the profitability is handsome. We need to teach this and exercise it so the more people can take advantage of it, so we can buy more assets, because even the ultra wealthy only have so much capital that they can deploy everybody runs out of capital. So we need other people doing well so we can continue buying large assets to continue growing our wealth. Because one of the most important things that successful people do in that study is they utilize other people's money. Other people's money. And so they found out other people's efforts, other people's ideas, and other people's money. Those three things are what the wealthy, the ultra wealthy do to get wealthy that 97% of our population never exercises. And so other people's money is where it's at. You take other people's assets, their money, their equity in their property, and you let them finance it for you. Take your credit card's money. If Chase Bank wants to lend you the money, take it. If Merrill Lynch wants to lend you the money on a credit card, take it. Utilize it as a down payment on these properties and then pay it back once it's stabilized. Just make sure that you don't over leverage yourself and then you land up stuck trying to service debt and then you land up ruining your credit or losing an asset. That's the one thing you don't want to do. So make sure you never over leverage or do your underwriting well. And that's why I always tell people every single time I get on stage, every single time I'm talking, every single time I get the exact same question, and people want to know how they get into real estate with no money down. And I sit back and say, you can get it done. And how do I get involved in real estate at all? That's another question. How do I just get started? The best way to get started in real estate, ladies and gentlemen, is by underwriting deals. By not even purchasing, just underwriting deals. Understand the game. Understand the numbers. This is a numbers game. You don't have to be great at math. You just have to be great at simple math to be able to expense all your costs and see what that property has the potential of cash flowing based on comps in the area, and then subtract the margin of expenses and the profitability, see what the profitability is. And if there's enough cushion there that it makes you feel warm and fuzzy and you feel good, there's not a science behind it. I just want to make sure that it's going to cash flow enough to pay for itself and have a little cushion set in place so that if something goes wrong, I can service that debt. Okay? And so it's as simple as that. You got to underwrite deals. You got to be out there underwriting deals. That way when people say, well, how do I know if I'm not over leveraging myself? That's how you know. You've gotten so good from underwriting deals that if you continue underwriting deals, when you go in and do owner financing, you're using other people's credit and other people's money to leverage assets in your name, you can go in and buy no money down real estate, no money down out of your pocket without the liability because you've gotten so damn good at underwriting deals that now you can feel confident in turnkey transactions where you're getting owner financing, using other people's money to say, yeah, I'm ready to go. This is the deal I need. Because you've underwrote it. And that's the best way to get started in real estate, ladies and gentlemen. Okay, traditional lenders. I want to make sure I didn't miss anything here from you guys. If you're going to do a short-term flip on a real estate contract, another good point that I want to bring up to you guys is always you can negotiate interest-only payments to the seller, or you can even amortize it over 30 years. You can still have a 3-year call on the note. You can say, okay, we have a 3-year balloon payment and a 3-year call on this, but I want to amortize this over 30 years. So you have that same amortization. So that way you're paying just a small amount towards principal, more towards interest, but it gives you that revenue. It gives you more working capital to be able to put towards your asset to stabilize it quicker so that you can refinance it. Okay. Most commercial loans are going to be between 5 and 20-year deals. They typically don't go over 20 years, but I'll still an owner financing sometimes amortize them over 30 years. So I get a little bit of payment towards principal, or I'll do interest only if I want to do a quick flip on them. Okay, 3 calls, ideal, 6%, 7% APRs, never overpay for a property. Oh, closing, real estate contracts. Okay, so people are sitting back going, okay, well, how do I close on the property? Look, just because you're buying with owner financing doesn't mean that you do anything different than you would do purchasing any traditional property, ladies and gentlemen. And what I mean by that is in any regular property that you buy, you're going to do an inspection. There's what's called a due diligence period, and you want to exercise your rights to do your due diligence on that property. Whether you're using traditional financing or doing owner financing, you want to do the same damn inspections. If it's a commercial property, you want to do an environmental phase 1. Make sure that chemicals haven't been dumped on that property. Make sure that there's not gas tanks on that property from an old gas station or rail yards from oil and kerosene that's in the soil. You want to make sure that property's clean. You want to make sure it wasn't a dry cleaner that was dumping cleaning chemicals into that soil, into that foundation. You want to make sure it's clean, okay? First and foremost. So you do the same inspections, structural inspections, roofing inspections, soil inspections, everything. You do the same inspections. You want to go in and do the exact same closing due diligence. You want to make sure that the property is free and clear of encumbrances, that there's no liens on the property. So you want to let the title company go back out and make sure that they're releasing clean title on that company. Or if you're in a state that doesn't do title companies, you have a real estate attorney that goes in and issues free and clear title on that company, on that asset, on that piece of real estate. So you want to do the exact same due diligence. Typically, when I do owner finance deals, I'll go in and I'll have an escrow company. I'll hire an escrow company and say, I'll pay for the escrow company. All the setup fees are just a couple $100. You maybe pay them like $15 to $20 a month to do the accounting for you. So they amortize everything for you. They take the payments. They pay the escrow company. The escrow payment company, you pay the escrow company. The escrow company pays the owner of that property. They record everything, and if you're late on your payments and you have late fees in there, they assess those late fees on their behalf. And then when that property balloons, they come back in, you go into that escrow company, and then they release free and clear title on that asset, and then they relinquish the debt that's owed to the original owner, and then they give you, from what's called a take-back deed, a regular special warranty deed or a general warranty deed, and give you full title and ownership of that property. And so if you're not in a state that uses escrow companies, make sure an attorney sets it up correctly for you so you have the legal documentation and document every single payment. Never pay your payments in cash. Always document your payments. Always pay them in check, money order, cashier's check, of some type of documented payment method, and every type of owner finance deal that you do. That stuff is super, super, super important. So anything that you typically do, tax-wise, property taxes, insurance, everything, you do the exact same thing when you're doing owner financing. And ladies and gentlemen, it's one of the most spectacular ways to get started in real estate. It's one of the most beneficial ways to get started in real estate. And I'll tell you that it has created a lot of wealth. Even to this day, you never graduate from owner finance deals, even when you get wealthy in real estate. And I'll tell you why. Because it decreases my liability. So the more money I make, I continue to go out after owner finance deals even to this day. It doesn't matter. You know, Ty Lopez and I, we partner on a lot of the stuff. First thing he always asks me is, will they take owner financing? It doesn't matter if he has billions of dollars in assets through Pier 1 Imports, Radio Shack, and all this stuff. It doesn't matter how many millions upon millions of dollars that I have and I've made in my industries, in my construction companies, and through my real estate. I'll still take free money from people that for the sake of ease and convenience on assets and purchases, and I'll ask every single seller, doesn't matter who, I'll ask every broker, will the owner consider owner financing? And they'll say, I don't know, it's a good question, I'll find out for you. And even if they say, well, I don't know, sometimes they'll come back with an excuse. Last time, they were talking about they really want the money out, and say, well, let's ask them. Just ask them, see if they'll consider it. And even if they can't owner finance the whole deal, let's say you have a $2 million deal, they may owner finance $1 million for you, which covers your down payment, and then you just have to obtain a loan on 50% of that asset. Then you go back and you can get lending on 50% of that asset instead of 100% of that asset, and it still works out very, very good in your favor. Again, other people's money. So, ladies and gentlemen, Real Talk on Real Estate, Friday morning. I want to talk to you guys a little bit about some of the updates. Look, if you guys are on Clubhouse and you guys haven't reached out, pinged me, and followed me, you need to do so. We just did a 2-hour free training last night on Clubhouse. Had about 60 people on there, probably about 100 people in and out of the room throughout the night. I brought you guys Antoine, who's a multifamily machine. This guy has over 1,400 units under roof right now. The commercial asset classes that he's been purchasing in for over the last 15 years are just incredible. At your fingertips, no cost. Todd Alt was there talking about syndication, some of what he's doing now through the recession. We had Matt Anise there, and Matt has been working in multifamily for many years. I was there for an hour and a half of the 2 hours, and I bring in a lot of knowledge and stuff in different sectors. So if you're not on Clubhouse, you get an invite, take that invite and exercise it. Free trainings all day long and conferences all day long. It's a great way, especially now during the pandemic, to get educated for free through Clubhouse. And then and so ping us, like us, and follow us on Clubhouse. Now, Wednesday nights, ladies and gentlemen, We started implementing this just before the holidays. I think we're on week number 6 of our free Wednesday live Q&As. If you're not part of the Real Estate Mentor Facebook group, you need to be a part of the Real Estate Mentor group on our Facebook page. Go in and follow, and for those of you guys from real estate, we'll accept your invitation, bring you guys into this private group. And we stream it live in the Facebook group every week. But not only do we do that, you want to be on our email list so that you get emails with a link to that free Q&A on Zoom every single week. If you're not a part of that Facebook group, you just go in, click on the Zoom link, and it's free. Live Q&A for those of you investors who have questions on today's show, yesterday's shows, next week's show, and to give us information on stuff you want to hear so we can create up-and-coming shows. You guys need to be a part of that group so that for that Q&A, you guys can come in, ask questions, and we can create content for you guys. These Real Talk on Real Estate are for you guys, not for me. They're for you. And we've committed. 2021 is going to be a great year. So look, in the comments section, I wanted to hear what type of topics we can help you with. What topics we can help you with, what dilemmas you're facing, what type of setbacks you're facing in 2021. What can Jerome Maldonado bring to the table and help you with in 2021 through my 25 plus years of experience to help you out in multifamily, industrial warehouse, construction and renovations, or any sector of retail and office. We've done all of that, ladies and gentlemen, and each and every day in this office, just in front of us here, we're doing land development projects going on right now that we're working on for 2 years from now. And so if you're in land, you want to find out a little bit more, let us know what aspects of any of those topics and any subtopics in those categories you guys want to learn on. And then hit us up on Instagram and Facebook, DM us and messenger us, and we're here for you. Look, ladies and gentlemen, another great Friday. I'm going to let you guys get back off to your day. I thank you guys for your time. You guys go out and compound your success, and God bless you.